Building wealth isn't about chasing quick wins or overnight success. It's about patience, consistency, and smart decisions over time. By focusing on long-term habits like saving, investing wisely, and avoiding unnecessary debt, you can grow your money steadily and securely. In this video, we'll explore how patience becomes your greatest financial tool and why slow, steady growth often beats risky shortcuts. So before we start, make sure to hit the like button and subscribe to my channel. Embracing the long game and defying instant gratification. The first and most crucial step in building wealth slowly is a fundamental mental shift. You must move away from the "I want it now" mentality and embrace the "I'm building it for the future" mindset. This requires a conscious effort to resist the allure of impulsive purchases, high-risk gambles, and the constant need to keep up with the Joneses. The modern consumer culture is designed to make you feel like you're missing out if you're not buying the latest gadget, driving the newest car, or vacationing at the most exclusive resorts. Patience, in this context, is an act of rebellion. It's the conscious choice to defer present consumption for future gain. This mental shift is the bedrock upon which all other wealth-building strategies are built. It allows you to make rational, long-term decisions rather than emotional, short-term ones. It's about understanding that a small, consistent contribution to your investment portfolio today is far more valuable than a fleeting moment of pleasure from a luxury item you'll barely remember in a few years. The magic of compounding and the power of time. Albert Einstein is famously credited with calling compound interest the eighth wonder of the world, and for good reason. Compounding is the process of earning returns on your initial investment, as well as on the accumulated interest from previous periods. In simple terms, your money starts making more money, and that new money starts making even more money, creating a snowball effect. The key to unlocking the true power of compounding is time. A small amount invested early in life has the potential to grow exponentially over decades, far surpassing a much larger sum invested later. For example, a 25-year-old who invests $500 a month at an 8% annual return will have accumulated significantly more wealth by age 65 than a 45-year-old who invests $1,000 a month at the same return. The difference is not the amount of money invested, but the number of years the money had to compound. This highlights the absolute necessity of starting early and staying invested for the long term. Patience allows you to ride out market fluctuations and downturns, knowing that time will ultimately smooth out the volatility and allow the compounding effect to work its magic. Mastering your finances and living below your means. Before you can build wealth, you must first get your financial house in order. This starts with a clear understanding of your income and expenses. Create a detailed budget that tracks where every dollar is going. This is not about deprivation, but about intentionality. By knowing your cash flow, you can identify areas where you can cut back and free up more money for savings and investments. Living below your means is the single most important habit you can cultivate. It's the simple practice of spending less than you earn. This creates a surplus that can be systematically directed towards wealth-building activities. This might mean choosing a more affordable home or car, cooking more meals at home, or finding free or low-cost entertainment options. These seemingly small sacrifices are the building blocks of financial freedom. They create the room to save and invest consistently, which is the cornerstone of slow, sustainable wealth creation. Automating your savings and investments. Consistency is the secret sauce of slow wealth building, and the best way to ensure consistency is to automate the process. Set up automatic transfers from your checking account to your savings and investment accounts on payday. This removes the temptation to spend the money before you have a chance to save it. When you make saving and investing a non-negotiable expense, just like your rent or mortgage, you are creating a disciplined system that works for you, even when your willpower is low. Whether it's contributing to a 401k, an IRA, or a regular brokerage account, automate the process. This disciplined, systematic approach takes the emotion out of financial decisions and ensures you are continuously putting your money to work, regardless of market conditions or your mood. It's the embodiment of patience, making the commitment to invest regularly and sticking to it over the long haul, resisting the urge to time the market. One of the biggest mistakes amateur investors make is trying to time the market. They try to buy low and sell high by predicting the next market downturn or rally. This is a fool's errand. Even professional fund managers with extensive resources rarely succeed at consistently timing the market. The patient investor, in contrast, understands that the most effective strategy is a buy and hold approach. This means investing in a diversified portfolio of low-cost index funds or ETFs and holding on to them for the long term, regardless of short-term market fluctuations. When the market goes down, a patient investor sees it as an opportunity to buy more assets at a discount. They don't panic and sell, locking in their losses. This is where patience is truly tested and where it pays off handsomely. By staying the course and not reacting to the daily noise of the financial news, you are allowing your investments to grow and compound over time, which is the ultimate goal. Spreading risk and avoiding all-or-nothing bets. Patience is not just about time, it's also about managing risk. A patient wealth builder understands that putting all their eggs in one basket is a recipe for disaster. They diversify their investments across different asset classes, stocks, bonds, real estate, and possibly even alternative investments to spread out the risk. Diversification ensures that if one sector or asset class underperforms, the others can potentially pick up the slack, protecting your overall portfolio from a catastrophic loss. This is the opposite of the all-in mentality of a gambler. A patient investor is not looking for a single home run. They are building a portfolio of solid singles and doubles that will, over time, add up to a championship. This disciplined approach to risk management is a key component of a long-term patient wealth-building strategy. The power of delayed gratification and the final reward. The final and perhaps most challenging aspect of building wealth slowly is maintaining a long-term vision. This is where the power of delayed gratification truly shines. It's about choosing to say no to immediate wants in favor of future needs and desires. It's the conscious decision to save for a comfortable retirement, for a child's education, or for the freedom to pursue a passion later in life. This vision provides the motivation to stay disciplined through the inevitable ups and downs of the market and of life itself. The reward for this patience is not just a larger number in a bank account. It is the freedom that wealth provides. The freedom from financial stress, the freedom to pursue your passions, and the freedom to spend your time how you choose. Building wealth slowly is not just about money. It's about building a life of purpose and security, and the patient pursuit of that goal is a rewarding journey in itself. The quiet revolution of patience. In a society that celebrates speed and instant results, building wealth slowly is a quiet revolution. It is a rebellion against consumerism and a commitment to personal responsibility. It requires discipline, consistency, and, most of all, unwavering patience. There is no magic formula, no secret trick, and no overnight success story. There is only the steady, deliberate march of a disciplined individual who understands the immense power of time and the magic of compounding. By embracing a long-term perspective, automating your savings, and staying the course through market volatility, you can build a financial fortress that will provide security and freedom for a lifetime. So, forget the get-rich-quick schemes. Embrace the marathon. Start today, stay patient, and watch your financial future flourish, one disciplined step at a time. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.